Hello, everybody. I'm James Leichter from Aptora, and I'm glad you are here. And Happy New Year in advance. We're going to be talking about how to get ready for the new year from an accounting perspective, but also we're going to talk about how to be ready long before the end of the year. Right now, it's a little late to be thinking about what to do with your taxes. You've only got about 20 days or so. But it's not too late to fix some of your bookkeeping and accounting issues, and I'm hoping that we'll be helpful with that today. I'm going to be following a guide that I wrote called The Ultimate Guide to Year-End Accounting System Cleanup, and you will be able to download that guide when we're all finished here. If I see any typos, I'll correct them on the fly, and you'll get the corrected version. This is something I actually wrote first in January of this year, beginning of the year, and then I revised it for today's webinar. Let's go ahead and get started. First thing I want to say though is this is not about Total Office Manager, the software that Aptora sells. If you don't have our software, it doesn't matter. All of this applies regardless of whether or not you use software. I mean, you could be paper and pen and almost all of this applies. If you use QuickBooks, 98% of this applies to you. If you happen to use NetSuite, probably 90% of it applies to you. So it really doesn't matter if you have our software or not. I think the first thing that I want to cover, I'm going to scroll down towards the bottom of this 15-page document till I get to software settings. So this part, I'll get this part out of the way. This is the Total Office Manager part, and we'll get that out of the way quickly. Total Office Manager has a lot of what I call fraud detection and prevention tools. None of them really have that label that I'm aware of that I can remember, but there's a lot of things in the program that are designed to prevent fraud, prevent problems, errors, mistakes. Doesn't have to necessarily be fraud. It could just be an honest mistake. The first thing you want to do is turn security on. Go to Preferences, go to Security, Company, make sure security is checked. If it's not checked, then there is no security. Everyone can do everything. Everyone has permission to do everything in the software. So it's obviously very important not to have security turned off. Also, in the security system where you assign permissions, you can assign permission to turn security on or off. And you don't want to assign that to just anybody, because I could turn that off, I could do bad things, turn it back on. Turn it off, do bad things, turn it back on. So turn on security. Second, nobody should be the administrator. No one should use the administrator account, I should say. When you log into Total Office Manager, you can pick administrator. The only time you need to do that is when you need to delete something that somebody else created that you couldn't otherwise delete. For example, if I create a user filter and I make it global, only I can delete the filter that I created. Well, what if I'm not at your company anymore? What if you don't know who created it? Well, you would know. You could open the filter and look at the bottom and it would tell you who created it. Maybe they're not there anymore. So what do? Well, you could reactivate them, log in as them. You could just also log in as the administrator and delete those things. Other than that, if you have permission to do everything in the software, then you could do virtually everything that the administrator could. The reason why the administrator shouldn't be used on an everyday basis is it makes it harder to tell who did what, because it's just the administrator. So use that sparingly. Password policies. You should have a policy where the password expires, say, at the minimum, every quarter, every 3 months or so. I think, to be honest, I think a month is probably too soon. I know a lot of IT people would disagree with me, but it's a pain to mess with them. But you don't want them to never expire. So I would do that quarterly, force people to create a new password. My opinion is you force people to deal with passwords too much and they write passwords on Post-it notes and stick it on their monitor. And you probably have seen that before because they're a pain to deal with. Granular user permissions. One thing the software allows you to do is have very granular permissions. I can allow you to do certain things but not other things. And it's important to go through those permissions and make sure that you're only giving people permission to do the things they need to do. Everything they do is written to the audit trail. Keep that in mind. The audit trail knows that people were in a record, they deleted a record, voided a record, so pay attention to the audit trail. Most every form in the software has a label at the bottom that indicates who created the record and when, and who last revised it and when. That can be very handy. You don't have to go to the audit trail. You might get the information you need right then. Credit card and bank reconciliations is something I'll talk a little bit more about, but that's a security feature. You absolutely need to do your credit card recs, your bank recs. Don't skip that. There are a lot of preferences and settings that control, again, who sees what, who can do what, in addition to security. Keep in mind, preferences are divided into my preferences, which is the user, and company preferences. You can allow me to see my preferences if you want me to, but you could prevent me from being able to see and manipulate company preferences. What I like to do for many users is set their preferences. So the my preferences are set actually by me. I log in as you, I set you up the way I want you to be set up, columns, etc. And then I keep you from getting back in there to change those preferences. That way you can control the user experience to a greater extent. Accounting period cutoff allows you to select a date where the software no longer allows you to edit records to the extent that account balances will be changed. So you could go back and look at an invoice, but you couldn't change the invoice to the extent that the numbers would change. It's very important to have a cutoff. Typically you set the cutoff as December 31st, say 2025, once your taxes have been filed. Once you file your taxes, then you go back and put a cutoff date for that tax year. You can always change things if you want to. If you set the cutoff date, you just need a special password, the admin password, or a special password that you can create to change those. Also, there are record approval features in the software where you could say someone needs your approval to create a purchase order, over a certain amount, to create an estimate over a certain amount, etc. When you go into permissions and set user permissions, the last screen allows you to set that up. So keep that in mind as well. That's it. That's all really I have to say that's specific to software programs, especially Total Office Manager. The next thing I want to cover is the owner's routine. And that way, if you're an owner, once you hear this, you can walk out of the room if you want to. If you're already bored and you're getting ready to walk out, hang in there for a minute. I want to explain how you can be involved in checking the books. And it's very important that owners be involved in doing that, even if they don't know anything about accounting. The first thing that I want owners to do is look at your bank balances. Generate a balance sheet and look at your bank balances. Do they look believable? You may not know if they're real. They probably don't match what's in your bank. They should be fairly close, but because of dates and things like that, they could be different. But do they look realistic? If you look at your balance sheet and you see that you have, say, $250,000 in the bank, ask yourself, is that reasonable? If that seems reasonable, if that's what you've had every other time you've looked, give or take, then move on. But what you're looking for is something that is too good to be true or too bad to hopefully be true. You're hoping it's not true. You're just glancing at those numbers, and if you want to know more, you can learn more. But if you're looking for a quick 20-minute checklist, this is how it would work. Run the balance sheet, look at your cash balances. Do they look reasonable? The next thing you want to look at is your accounts receivable. The most valuable thing that you have is your money in the bank, probably, right? It's the most liquid. The next is your accounts receivable, money people owe you for work that you've already completed. You want to look at that accounts receivable number and see if it makes sense. You probably won't be able to tell unless you run a report showing you a list of all the people that owe you money. If you're an owner that is very involved in the company, you are probably one of the very best people to look at the report, because you might not recognize a name, or you might recognize a name that shouldn't owe you money. You might see John Smith, who supposedly owes you money, but you know that they paid you. Just glance at the report, take out a pen, mark it up, write on it, write notes, whatever, turn it into somebody who will carefully review it and get back to you. You don't have to do the whole thing yourself. You are just giving it a quick smell test. You might do the same thing with an AP, your accounts payable, but likely you don't need to. It's AR that's way more important. If your books show that you owe a vendor money that you don't, that'll settle itself. If you want to keep it to 20 minutes, skip that. Just go to your AR, accounts receivable report, because that's one of the most valuable assets you have. Next thing you want to do is look at, on your balance sheet, look at your inventory number. What does it say, $100,000? This is great for an owner, because you could look around and ask yourself, do I have $100,000 worth of inventory here? And if you divide it out, like I recommend, serialized versus parts and materials, then you ask yourself, do I have that much here? Now, I said this part doesn't have anything to do with software. It doesn't. Software generates your balance sheet in this case, but if you're doing it manually, somebody's generating your balance sheet. It's the same question. You ask yourself, how much inventory does that balance sheet say I have? And is it realistic? Think about how much is in each truck. If you have maybe $7,000 in 5 trucks, that's $35,000. And you look around and you've got maybe $75,000 roughly in the warehouse. Well, that number's close enough. You don't need to worry about it. Again, we're trying to keep this to 20 minutes. Here's what I think will happen. The number's not going to be anywhere close. It might say 100,000 and you think you've got 200,000. The number could be 0 and you've got 200,000. That's a big difference. You're looking for a giant difference, and then you want to ask why. You don't need to fix it, don't need to understand it, but you want to ask why. You want to get an acceptable answer. Keep in mind, for every dollar your inventory is wrong, your reports are basically wrong by that same dollar. So in other words, and I'm oversimplifying things a little bit, but I don't want to get too nerdy into the accounting, which I love, but most people don't want to get into the nerdy part. If your balance sheet says that you have 200,000 inventory, but you only have 100,000, then you have $100,000 worth of mistakes on your financial reports. Your job costing's wrong, your income statement's wrong, your balance sheet's wrong. Your accounts receivable and accounts payable might very well be correct, but those other things are wrong for sure. So that's an important number for you to take a look at. The reason why I want the owner to do it is the owner can typically look around and have a pretty good idea of how much inventory they have. The next thing that you want to look at is your income statement. Print out an income statement for the whole company. Print out one by department if you can. If you don't have software, you're not printing it. Somebody's handing it to you. But you want to look at that income statement and ask yourself, does the gross profit seem reasonable? So we have revenue or sales, our sales revenue. We have that minus all the money we spent to do the work. That's gross profit. Look at those gross profit dollars. Look at the gross profit percentage and ask yourself, is that realistic? If you can do this by department, it's really helpful. So for example, service department, 63% gross margin. That's realistic. That's pretty good for most companies. But a 80% gross margin, that's fantastic. I don't believe it. That's so good, I don't believe it. I can't tell you how many times in my coaching work I've looked at an income statement and the room was practically, clapping because it was so great. And I've said, I don't believe it. It's too good to be true. But it also could be too bad to be true. Typically, there's a combination. If you have one department that's too good to be true, you might very well have another department that's too bad to be true, and the truth is somewhere in the middle, meaning the bookkeeping needs to be improved. One department recognized income it shouldn't have. One department could have recognized COGS that it shouldn't have. So you're just seeing if it passes the smell test. Are the gross profit margins realistic? Another thing to look at is fluctuations. If you can have your monthly income statement, and if I were you, I wouldn't rely on the computer, I would hole punch them and put them in a binder. I'd look at January, February, March, April, May, June, July. I'd get out a pen, a highlighter, make notes. But if you see fluctuations from one month to another, that can be a sign of bookkeeping issues, something called timeliness. Look into that. Again, don't have to know how to fix it. You just have to say, wait a minute, why is this? And have somebody explain it to you. Take a look at your payroll and sales tax liabilities. Are they realistic? Does your balance sheet show that you owe a lot of money for sales tax or that you owe a lot of money for payroll taxes? Well, you may not. You may not. So check into that. Ask questions. Look at other liabilities. Look for banks, credit cards, things like that. Do you have credit card liabilities on your balance sheet? You should. If your company uses credit cards, you should have a credit card liability. You should show at any given moment how much you owe the credit card company. Take a look at that. Same with banks. Look for interest. If you're borrowing money, then you're probably paying interest. Where is that interest? Look for interest on your income statement. If you don't see interest expense, then it's not being accounted for properly. Go to your balance sheet. If you don't see that bank loan, then it's not being accounted for properly. If you don't see loans against vehicles, equipment, things like that, then there's room for improvement. Also, look for new bills that you don't recognize, expenses that you don't recognize. On the income statement, is there anything you don't recognize? Go to your list, any software program or any manual system for that matter. Look for bills that you don't recognize, new expenses that have come up from nowhere. One thing you're looking at, again, just briefly, is you're looking for all these little monthly fees that people often sign up for and they never get rid of. It's $20 here, $10 there. You're looking for these because no one else really cares about them. No one cares about $10 here, $20 there, $50 somewhere else like you do, the owner. So be on the lookout for that. I know it's a small number, but again, my point being is few people really care about those because they're small numbers. Another thing you can look at is overused journal entries or adjusting journal entries, where a person goes into a form where they're putting in a number for a credit and putting in a number for a debit. Again, you don't have to know much about that, but you should know where to find them. Go to banking in our program, QuickBooks, go to banking, go to banking, go to journal entry list, look them over. People often tend to use journal entries to cover up problems. And that's about it. You can do that in 20 minutes. The most important part, if you said to me, that's too much work, can you make it 10 minutes? Just glance at a balance sheet and look for things that are weird. Look for things that are too good or too bad to be true. Do the same thing with an income statement. You can spare 10 or 15 minutes doing that, and you will find problems, believe me. Okay, so owners, you can leave now. If you're bored with this, I don't blame you a bit. You can walk out of the room. Just don't let anybody else walk out. Let's go over a more thorough checklist on what I'd like to see done on a regular basis. Again, you'll get this document, so you don't have to worry too much about writing stuff down if you don't want to. Every month, a qualified person should go through a checklist. And I have a checklist version of this in the document. But they should go over a checklist. Why do a checklist when you've got 15 years experience doing bookkeeping and accounting? Well, you could be a pilot with 15 years experience. You could be a pilot with 30 years experience. And by law, you have to go through a checklist. By federal law, you have to follow a checklist. So they're not too good for a checklist, and neither am I, neither are you. Go through a checklist so you don't forget something. This is important stuff. This is your business, your money, your livelihood. Somebody needs to do this, and somebody needs to be you or somebody you trust thoroughly. Let's go over it. First thing you do on a monthly basis, that balance sheet look. But yours is a little more complicated, a little more in depth than the owner would be. But it's the same process. Reasonableness. Are these numbers reasonable? Do they look too good to be true, too bad to be true, etc.? Are you seeing things that you would expect to see, like inventory numbers going up and down from period to period? They should be. Are balances on loans going up and down from one month to the next? Well, they should be. You're making payments. Do the same thing with an income statement. Look at the income statement. You're not going to see a balance on a loan, right? Because that's a liability. That was on the balance sheet. But if you saw that on the balance sheet, you should see interest on the income statement. Look for interest. Do you see it? You might be paying it, but it might be buried into something else, and you want that detail. So just give those things a good hard look. And again, you're asking yourself, do they make sense? Fluctuations are typically a sign of bookkeeping issues, accounting issues. You shouldn't see a lot of fluctuation. You shouldn't have one month where you made a ton of money and you didn't seem like you're that busy. And then you had another month where you made a ton of money and you weren't busy at all. So people will often tell me, why is it that we were really busy in July and, we didn't make any money? And then here comes August and we weren't as busy and we made all this money. How could that have happened? Well, there's a lot of things that could have happened, but oftentimes when they ask me that question and I dig into it, it's timeliness, what accountants call timeliness. So in July, you bought a line set and paid for it, and in August, you sold it. So in August, you could have recognized the income, but not the COGS. And in July, you could have recognized the COGS, but not the income. And that's a line set. What about the condensing unit, the heat pump, the air handler, and a bunch of other stuff? That could have happened. You have to recognize costs of goods sold at the same time you recognize income. And when you recognize income, at that same time, you should be recognizing costs of goods sold. Timeliness. That's usually the issue, timeliness. I can't get a decent job costing report out of this thing. I've heard that a lot. Timeliness. As long as you're picking the job, it comes down to timeliness. Another thing that can affect that is using inventory parts versus non-inventory parts. No matter what software you use, if you use no software and your accounting is manual, this is how it works. A non-inventory part is never an inventory. That's why it's called that. So you recognize your cost of goods sold when you buy it. So if you have a motor and it's non-inventory, you recognize the cost of goods sold the minute you buy it, but no income. When you get around to selling it, you recognize the income, but there's no COGS. That's why one month can look really bad when it didn't feel like it should have been, and another month can look really great when it shouldn't have been that great. Timeliness. Inventory part, though, when you buy it, it goes into inventory. There's no COGS, there's no income, there's no revenue. It just sits in inventory as an asset. When you go to sell it, that asset is removed from inventory, and you now have a COGS and income. Timeliness. Same day, same moment. Nice reports. All right. Accounts receivable. Same thing as I mentioned before, but more thorough. You're looking at it more thoroughly. Now, as I mentioned, a lot of times there's no one better than an owner to look at accounts receivable, especially to be involved in just glancing at it, because they might say, we finished that school, that job's done. Why do we still have money owed to us? Or, look at this retainer, we should have collected on that retainer. Oh, I think we forgot about that. There's probably others we forgot about. So you're looking at that accounts receivable report, maybe not line, by person, by penny, although that should be done occasionally, but you're just looking at it to see if it makes sense, and when you feel like it doesn't, you're digging further. Remember, at least in my opinion, there's only so much time to do anything. I'd like to spend hours on that accounts receivable report, but I may have other things to get to, so I'm scanning it to see if anything really worries me, and only then am I digging further into it. Remember, this is monthly. We could dig much further on a quarterly basis. If your company does progress billing, percentage of completion, AIA, you want to pay a particular attention to your accounts receivable report. And in this case, you might be looking for something that's not there. You might be saying to yourself, wait a minute, that school job, we finished it, they should owe us money. They're not on there. That's another thing you're looking for, is things that aren't on there. That takes me a little bit further in this checklist, but somebody needs to look at estimates to see if they've all been invoiced. You need to go through all your estimates. Look at the ones that are awarded. Well, first of all, have all the awarded estimates been marked as awarded? Yes, I just fixed that. All right. Now I want you to go through all the estimates that were awarded to see if they've been invoiced. And if they have they all been invoiced? The entirety? Have you invoiced all of it? So that's why you're going through the AR report, to see if it just makes sense. Is there anything about that that worries you? Same way with accounts payable. Now, the nice thing about accounts payable is there's vendors worrying about whether they get paid. I'm not saying it's not important. I'm just saying that we owe them money, not the other way around. You want to pay a lot more attention to what is owed to you than what you owe others. I understand there's more to it than that, especially if you're worried about cash flow, but hopefully you get my point. My point is we only have so much time to do this. Vendors, we owe them money. They'll get paid. They'll get their money. If we forgot to enter the bill, they're going to remind us. Chances are they're not going to forget it because we forgot it. But accounts receivable, we forget it, they forgot it. It's doubtful you'll get a call from someone that says, I'm really worried that we haven't given you enough money. Payroll liability review. There's no way that you're going to know, unless you really dig into it, if those payroll liabilities are all perfect. But here's what you're looking for. Are the payroll liabilities being reduced to zero at some point? Because they should be. If you're using the software correctly, then you know you're supposed to use the payroll liabilities feature. QuickBooks, NetSuite, Total Office Manager, doesn't matter. You can't just write a check for it. If you do write a check for it, the software doesn't know those liabilities were relieved. So you'll see that on the balance sheet. You'll see payroll liabilities still there, even though you paid them, but they're still there. Why? Why are they there? The software didn't know that you paid them. That's the kind of thing that you're looking for. So look at your sales tax, look at your payroll liabilities, make sure that they are being taken care of. If they're not, then you have a setup issue. Finally, you could have a rounding account. Chances are all of you have a rounding account on your income statement, your balance sheet. It should be a few dollars. That's just to handle rounding that's normal in accounting. You might have millions and millions of transactions, and things just aren't going to always line up perfectly. So there's a rounding account. Pay no attention to it if it's a few dollars. But when it gets to be hundreds of dollars or tens of thousands of dollars, which I've seen, that's a problem that needs to be addressed. All right, so you do that every month, you're going to eliminate a lot of problems that you would otherwise find maybe at the end of the year or maybe never. But now it's time to do our quarterly cleanup procedures. First of all, when you start your quarterly procedures, you're going to begin with your monthly, because your monthly don't go away. You do your monthly first, then you do your quarterly. On a quarterly basis, you're going to want to review your loans and amortization schedules. Let's say that you have a truck, 48 months financed, and you've been making payments for 24 months. Your balance sheet should accurately reflect how much you paid for the vehicle, how much you've depreciated, what the balance is on the bank account. Most important thing to me is the balance on that bank account. If that's not correct, it's not being accounted for properly. When you go to the balance sheet, you might see, when you go to the income statement, you might see one line that says interest, and that's fine. You may not know what the interest is for, which loan. You can always double click on it to get a TDBA report that'll tell you more about it. But that's fine, but you should have interest on there. On your balance sheet, you should see on a monthly basis those loan amounts dropping if you're making payments. A good thing to do is to drill down to the check or the bill and the check and examine it. Should have at least two lines on it. Line 1 should be for interest and line 2 should be for principal. So you should be seeing two lines on each transaction, one of which is reducing your loan and the other is increasing your interest expense. So check those out very carefully. Make sure they're set up right. Adjusting journal entries, as I mentioned before, adjusting journal entries, and again, this is not software specific, but let me tell you where real quick. Go to banking, go to journal entry list right there. Check those out. Now what you might see in there are memorized entries for things like interest or amortization. That's fine typically. But what you're looking for is just a lot of adjusting journal entries that are correcting bank liabilities, they're correcting payroll liabilities, and by the way, there's a place for that. So you don't correct sales tax liability there. You don't correct payroll tax liability or payroll liability there. You don't do it there. That's the wrong place. That's what you're looking for. You're looking for entries that correct things. You shouldn't need that. In most cases, you shouldn't need it. Most companies should not have very many adjusting journal entries on a monthly basis because they are typically your last line of defense against an incorrect account balance. What an adjusting journal entry allows you to do is tell the software essentially to shut up and mind its own business. The software reports an account balance to you, and how does it know that? It looks at all the transactions that made up that balance and it sticks it on the balance sheet or the income statement. Well, you say it's wrong. Well, if it's wrong, you should go correct the transaction or the transactions that created the problem. If there's too many, you might do an adjusting journal entry and you correct the problem from this day forward. But then the adjusting journal entry should have a very good memo in it. Good accountants have good memos. That memo is on the header and you have a memo opportunity on every line item. You should use every character in many cases to describe what you did because it should be a one-off. It should be to correct something that's been wrong and you now are doing it properly. The memo should reflect that. So look at those adjusting journal entries and look for too many of them. Look for those that don't have good comments, good notes, good memos, and just seem to be correcting things that should have never been a problem to begin with. Again, remember, an adjusting journal entry, with some exception, is only there as a backdoor method of forcing the software to accept a number that you want it to accept and it doesn't want to. Inventory reconciliation and tracking. Talked about that earlier, but on a quarterly basis, we need to do some counting. You really should count your inventory quarterly. When you discover that after you count it, it's not off by very much. Like a company recently did their accounting that I work with. They did their inventory counting and they found that they were off by such a small amount that they decided that they were not going to do it monthly anymore. They were going to go biannually. They were that close. If you count every quarter and you're really close, then you might decide you're going to do it biannually, every 6 months, and a really thorough one at the end of the year. But again, the reason why you are counting inventory is for every dollar that number is incorrect, then your reports are incorrect by that dollar. You don't always know where or when, but you can count on it. It's just a rule. It's an accounting rule. It has to be. For every dollar you're off, your reports are off a dollar. So do a physical count every quarter. You could do a rolling count where you're counting every day, every week. You're just counting something different. Like you could count motors this week and you could count controls next week and you never really have an inventory day. You're just constantly counting different categories. That's fine too. What should you count, by the way? You're really only counting. Now, remember, I have to give pretty simple answers here. I could give more detailed answers, but what are you counting? You're counting what the software is counting. So you're counting serialized items and you're counting items whose type equals inventory part. That's what you're counting because you want to correct the software if it's wrong. So you're counting what the software counts, and it only counts those two things. What you could also count on a less regular basis are things that you need to keep, but you're not tracking, such as mastic, tape, screws, wire nuts, things like that. You may not track how many of those you have on hand because they're classified as non-inventory parts or even classified as an other charge, but you still need to count them on a somewhat regular basis so that you know how many of those you have. But you're counting what the software is counting. You want to review progress invoices and awarded estimates on a quarterly basis. Remember, we glanced at these things less carefully on a monthly basis, but every quarter we need to get real serious because time's running out to bill people if we forgot. So here's what I'm getting at. You have an estimate that's awarded. Did anyone create an invoice? Well, maybe they did. If they created the invoice from the estimate, it's a lot easier to tell. But what you're trying to do is make sure that invoices got created from the estimate, if there was an estimate. You don't want an estimate to be approved and we forgot to invoice. Now, I've seen situations where we've had estimates approved, signed, but the work hasn't started. But the terms of the sale said that we could invoice them a certain amount of money. I've seen situations where we ordered equipment, but the job hadn't started. It got delayed. But the terms of the sale said that we could invoice them for that equipment or for a percentage. You get the idea. You want to make sure that you're invoicing everybody that you can possibly invoice and no one's been forgot about. It's also true, by the way, for work orders. You want to look at work orders and make sure invoices were created. There's a feature in our software that says no invoice is needed for this work order. You can check that box if that's truly the case, but that should be super rare. Even if it's a no-charge warranty or a no-charge callback, you need an invoice. You need an invoice for proper bookkeeping, for proper inventory. It's an invoice with 0 at the end, perhaps, but you need an invoice. The software will tell you all the work orders that have not been invoiced. So you're basically looking to see if work orders that were completed were marked as completed. Same way with an estimate. Estimates that were awarded were marked as awarded. The next thing you ask yourself is, work orders that were completed, estimates that were awarded, did we ever create an invoice? If we did we create an invoice for the entire amount? Have we gotten paid every bit that we deserve? That wouldn't show up on your accounts receivable report. You wouldn't always know. If you forgot to invoice somebody, you may not see that on your accounts receivable report. You won't see it on your balance sheet, your income statement. You wouldn't see it on anything. Not unless you had a report that said, give me a list of estimates awarded with no invoice or a balance is due. See how easy it'd be to forget that? Some of you have forgot it. I know you have because I've gotten your angry calls saying, why did we let this happen? Well, it happens. The software, no matter what software you have, manual bookkeeping, it can happen. Somebody's got to check that. So again, work orders and estimates, do they have the proper status? If so, have they been invoiced? If so, for the whole amount? All right. Annual cleanup. So that's done every quarter. You can imagine if you do these things monthly and do those things every quarter, you're not going to have a lot of things that are going to slip through your fingers. Also, those things that I didn't mention, you'll detect them. You'll start understanding it better. You'll start saying, well, that James, he never told me to look for this. This is important. You'll catch on to those things that are very important. Annual cleanup procedures, preparing for the new year. You want to do a full liability review. This is the most thorough review of your liability. So this is when you are grabbing bank statements, you're grabbing credit card statements, loan statements, and you're making sure that all the amortization and interest was recorded properly in your financial system. This is where you might make one of those adjusting journal entries. Adjusting journal entries all year long are unusual But an adjusting journal entry or a bunch of them at the end of the year, those aren't so unusual. That's pretty typical. So what you're doing in many cases is you're putting in an adjusting journal entry that corrects a problem that you have now corrected. And you have SOP moving forward. And hopefully you've set it up now so that it won't be wrong next year. But you've detected the problem, you do an adjusting journal entry, and you get it fixed. As I said earlier, if the problem involves sales tax liability or payroll tax liability, you don't do adjusting journal entries for those. You go to the sales tax liability tool, you go to the payroll tax liability tool. Even if you're a QuickBooks user, that's the tool, not a journal entry. You want to adjust your current and long-term liabilities on loans, as I've mentioned. Those are almost always wrong. If we are involved in this work for someone, we almost always find those to be incorrect. Almost always. Number 3 is pretty much related. A fixed asset and depreciation review. Have you ever noticed, I'm looking around to see if I have an example, I don't. Have you ever noticed assets, you go to, like junior college or something like that, and you'll see stickers on all the assets, maybe with a barcode scanner? Well, that's part of their annual asset review. Every asset gets that sticker, and somebody probably goes around and starts scanning all the stickers. Once all the stickers are scanned, they compare that to how many stickers they thought they had, right? So on column A, this is all the stuff we think we own. Column B is the result of Bob walking around scanning all those labels. We got a problem. Some of those labels either didn't get scanned or that stuff is missing. That's an asset review. The other thing you want to do is make sure that you have been depreciating those assets properly. This is probably something an outside accountant can help you with. You just need to look at the number to see if it passes the smell test. But you want to make sure that your assets get on your balance sheet for their full value. And then they are depreciated over time, which can sometimes be in the same year or over many years, depending. But you just want to make sure you see those numbers. And if they don't look right to you, if they don't change on a regular basis, then you want to be asking questions. The boss starts asking questions, then things get fixed, even if the boss doesn't really understand what she or he is asking about completely. You don't have to. Fixed asset depreciation review. But that's done, just to be clear, I mentioned the boss, that's done by the experts. You want to be sure that's correct. Departmentalization review and chart of accounts cleanup. Departmentalization. If you follow our advice, if you've heard me talk, then you know I really want to see your financials by department, by operating division, by profit center. Those things can mean the same. I want to see demand service. I want to see installation and add-on. I want to see preventative maintenance, which includes service agreements. If you do new construction, I want to see that. If you do plumbing, electrical, residential versus commercial, I might have that too. But I want to have a good set of departments, profit centers that make sense for your company. This is the time to go look. Print an income statement for the demand service department. Does it look like it makes sense? Do the same thing for other departments. Do they look like they make sense? If they don't, then there's opportunities for improvement there. We need to make sure we're picking the right department when we're doing our bookkeeping. You also want to look at your accounts, your chart of accounts, to make sure that they are adequate, that you don't have too many things on your chart of accounts, and that you have enough, that it's given you the detail that you would like. Great example, I was working with a coaching client just 2 hours ago, I guess it was. And we made a change in 30 minutes that gave them way better reports. Their service agreement, their planned service revenue all went into labor, because it's mostly labor. And all the costs of goods sold went into parts and material. The problem with that is they couldn't see the revenue coming in for planned service, and they couldn't see the costs going out for planned service. So we just simply added 2 new chart of accounts. We had planned service income and we had planned service discounts. And now when we create an invoice, we're tracking plan service income, and when we give a discount because they have a plan service agreement, we use a discount item that points to plan service discounts, which is an income account. And now when they print their income statement, they can see two lines: all the revenue for plan service, all the discounts for plan service because they get a discount. They can also print a departmentalized income statement for plan service, and they can not only see revenue, cost of goods sold, but now they can see overhead. By knowing their gross profit, they can now, gross profit margin, they can now see if they're profitable. So when I left the call, it came down to, well, now we know what the gross profit is. Let's go run one more report. They had a few things they needed to do first, but let's go run a report and see what our overhead is. If our gross profit margin is 50% and our overhead is 55%, then it costs us 5% to do plan service. 30 minutes of work and we have that answer. So check out your chart of accounts. Another thing to look for, by the way, is too much detail. If you have 350, 400, 500 accounts on your chart of accounts, that's probably too many. If you have 50, that's almost certainly not enough. You want more than that. What's the sweet spot? It's hard to tell, really. Mine has about 265, the one I recommend for most every contracting company, about 265 items. About 150 are used on a regular basis and the others less so. One common mistake on your chart of accounts is too many marketing methods. If you use our software anyway, too many marketing methods. One nice thing about Total Office Manager is you can put in all your marketing methods. You can put in your marketing campaigns. And when you do AP, when you write a bill, you write a check, you pick the marketing campaign or marketing method that it's tied to. Well, your chart of accounts only needs to have potentially one line item that says marketing. You could divide that out by SEO, etc., but only a handful. You don't need one for billboards, yellow pages, SEO, PPC, etc., because that's tracked through the marketing campaign manager. So look for too many things in there. You may not want to list every vehicle, for example. You may not want to list every credit card, but if you have a reason to do so, that's fine. Accounts receivable cleanup at the end of the year, that's the time to make a decision on bad debt. So we've been watching that John Smith guy I mentioned earlier. He never paid, and we just want to write the thing off. Well, now's the time to do it. Do that at the end of the year. If he ends up paying you, you can always restore that. You can always put that income in, but you want to recognize that bad debt in the year that it occurred. Now, if you happen to be doing this in February for 2025, you're doing it in February of 26, that's fine. You go in to receive a payment. You can date the received payment on the day it happened or the day you're writing off the bad debt, because when you go to receive that payment, you can use the bad debt feature and the as of date. And if the as of date is 12/31/2025, well, then that gets on 2025's income statement, and that's the way to do it. You date it the day it happened, but you can write it off with an as of date. But now's the time to write it off, and you can bring it back if you happen to get paid. Same way with sales tax, payroll taxes. Now's the time to get them cleaned up, taken care of, end of the year. We talked about your financial statement review and year-end close. Your final step, when you are confident that you've made all the changes that you need to make to straighten out your books, your final step is to close the accounting period, as I mentioned. But you might wait until you're absolutely sure everything's fixed. Maybe that is when you file your income taxes, but you want to get a lot more strict when you file your income taxes. Here's what I'd recommend. If you're using our software, you go into preferences and you go to the cutoff date. And as soon as you feel like you're in good shape, put in a cutoff date right there. You still can make changes, but those changes will only be made by someone with the correct password. So that way, if somebody says to you, it says I need an admin password, something about a cutoff date, then you can question them. Why are you making that change? Might be legit, maybe not. Another thing that you want to do, as long as I'm in here, this is software specific, but I'm in here and it'd be bad not to show you this because this happens to people. Open up your invoice list. And you'll notice that you have a filter in here called out of stock serialized items. And then you can type in yes or no, true or false. Either one will do. I'll just type in yes and click go. And we'll give it a minute. Found 65. Found 65 of what? What did it find? It found 65 invoices that contain a serialized item type, one or more, with no serial number selected. What? How can you do that? Hopefully you couldn't. Hopefully you can't. Hopefully you'll find 0. But in preferences, and when it was put in, it was shipped, turned off. In preferences, there's a preference that says, allow me to sell serialized items and not pick a serial number. And when you check that box, it says, are you freaking kidding me? Are you sure? And you say, yeah, I'm sure. I own the software. Mind your own business. And it says, all right, fine. I need a password. And you put in a password. And that whole thing got written to the audit trail. So it's in there if you want to know who did it. It's in the audit trail. Now, with that turned on, and only you could have turned it on. Only your company could have turned it on, not us. No updates, nothing. Now with it turned on, you don't have to pick a serial number. All right, well, why is that a problem? You don't pick a serial number, then it didn't relieve that item from inventory, and it didn't create a cost of goods sold. So those have to be fixed. So I need to go to all 65 of these and pick a serial number. And if I can't find this serial number, then I got a big mess. Then I'm upset because now I just found tons of work for myself because I got to find out if we sold it to somebody else by mistake, if we never entered it. So it turns out we never entered that serial number. I can't find it anywhere, and I got a lot of work to do. That's a bummer. There are tools for that. Keep in mind, we've written articles, we've added tools, but what you can do is go to your, well, let me click the right thing here. Go to your serialized item list, serial number list right there. That's the serial number of everything you've ever bought and sold. Go there and try to find it. And if you find it, then you'll figure out what happened to it. If you don't find it, unless it was like entered by mistake, and in that case you should still see it, then you'll know if you ever entered it. If you never entered it and you're sure of it, then you need to enter a bill for that. And then backdate the bill and then go back to the invoice and pick the serial number. If it turns out that you sold it to somebody else, you got to go back to the invoice, fix the one that you sold the wrong one to, come back to that invoice and pick it. But either way, this company has 65 invoices that need serial numbers, at least one per 65. So that's a bit of work. A lot of times this happens, this gets messed up when, like you might find that feature's never been turned on, but you still have problems. A lot of times we'll sell the wrong serial number, or we will sell someone an evaporator coil, turns out it's leaking. So we return it, and we get another one, and we go install it. But no one ever took care of that in the software. You have to take care of that on paper. If you had a paper accounting system, you'd have to go fix it. Same way with software, any software, you got to go fix it. That's a common problem. If you're wondering how to handle that, we got a help topic on that. Just push F1, go to our website. We've written about all of these things, but you want to correct your serial numbers. Now, before you do that, since I'm in the software, before you do that, you want to visit your vendor menu, slide down to your receive items list. And you shouldn't see anything on here, or you should see things that you would expect to find in this list. So what are these? You probably know already, but you created a PO, you received the items. You haven't got the bill yet. When the bill comes, you go to enter a bill for received items, and it gets rid of the item receipt. It drops off this list because now you have the bill. This is a temporary place until you get the bill. This is how you receive items in inventory so that you can sell them and deal with them. But when the bill comes, you receive against the item receipt, it disappears. If you're a QB desktop user, it's exactly the process. If you came from QB but aren't doing it in here, it's the exact same process. If you enter the bill and ignore the item receipt, you've now doubled the charge. So that's actually good news. If you go in here and find $10,000 worth of item receipts that should have disappeared, the good news is you got $10,000 more in profit than you thought you had. But be sure at the end of the year there isn't anything in here that shouldn't be in there. Now, once you do that, you're ready to go to the invoice list because you might have corrected some serial numbers. Now you're ready to go to the invoice list and pick the out of stock, yes, and pray that nothing's in there because that is a lot of work. Okay, so in a moment, we'll wrap this up and you'll have an opportunity to ask questions if you'd like to. And after it's over, we'll give you an opportunity to download this document. Towards the end of the document, I provide a comprehensive checklist. Okay, so this assumes that you pretty much know what you're doing. Like, go back to the pilot. I said by law, pilot goes through a checklist to take off and land. You pretty well know how to take off by now. You go through the checklist. It's not a user manual on the airplane. It's a checklist. That's what this is. So you go through this checklist. You can use this for QuickBooks, by the way. Go through the checklist. And it covers the things we've been talking about. There's your monthly. There's your quarterly. Quarterly is really small, but keep in mind, you're also doing your monthly. So when March rolls around, you're doing your monthly for March, but you're also doing the extra quarterlies. And then you add to that the annuals. And they're divided out into different areas. And then you're closing the books with your year-end review. At the end, I have the 20-minute checklist for the owner, and that's how we end the document. You'll notice I slide up here to the top. There's the table of contents. I started to say chart of accounts because I have that on my mind right there. So it covers a lot of good things. All right, with that in mind, I think we'll go ahead and stop here. It's been 1 hour. I could go on for a couple hours and show you a lot of details, but here's the thing. Accounting issues are a whole lot less frequent if you set things up properly. That's what we're here for. If you have any questions about setup, just talk to us. Talk to your accountant. Tell them you got a software program that's just like QuickBooks Desktop. They'll probably say, well, I missed the QuickBooks Desktop days. Let me see this thing. And they could probably help you with setup. Once setup is good, then catching problems early makes them a whole lot easier to resolve. 3 invoices that need serial numbers is way better than 33. Catch them early, write SOP so it doesn't happen anymore. Think about preferences that need to be turned off, permissions that need to be taken away so these things don't happen anymore. Once you get things cleaned up, then moving forward, they should be a lot better. But make sure your financial reports pass the smell test. All right. Will, do we have any questions from anyone?
We have no questions.
No questions?
No questions.
Is there anybody out there still, Will? Are they all gone? Did they all just disconnect like 50 minutes ago?
No, they're out there. I guess you just explained it really well.
He says no. He says they're still there. Because I thought Will might say, no questions and no one's on here listening to you.
Susan just commented that she's here.
Susan's here. Okay, good. All right. Well, I enjoy these webinars, and I'm glad everybody came to the webinar. Let us know what kind of material you want to see, or any extra webinars that you would like to see, any articles you'd like to see written. If you haven't checked out our articles, by the way, I guess this is the closest thing I have to a sales pitch, but there's nothing to sell. Go to our website and check out our blog. If you haven't done that lately, there's some great articles I know because I have bags under my eyes writing a bunch of them. Same way with many of my coworkers. We've written a bunch of stuff. It's quite good. And then also go to the support area at aptora.com, and you'll notice there's articles on these things I've talked about, like correcting serial numbers and all that stuff. All right, so until next time, thanks again for being here. I'm James Leichter, president of Aptora, and on behalf of my coworkers behind the camera and everybody at Aptora, we love and appreciate you. Happy New Year. See you next time.